All right, good morning, everyone. It is so good to see you for our first in-person conference since the pandemic. My name is Pavlina Cherneva. I'm the president of the Levy Institute, and I'm delighted to welcome you to our 32nd annual conference of the Institute. We meet at a point in time where the global economic order seems to be unraveling, and the Levy Institute is made for moments like this, moments that demand rigorous analysis, clarity of thought, bold policy proposals. And you are here because you know our impact. For over 3 decades, actually almost 4, next year is going to be our 40th anniversary since the founding of the Institute. For almost 4 decades, this institute has shaped the discourse in the US and abroad. Our work on financial instability was the go-to analysis for understanding the causes and consequences of the 2008 financial crisis. Our work on modern money really defined what was possible during the COVID pandemic response. And our work on the economic well-being and the job guarantee has influenced policy discussions around the world and the work of international organizations. As I have outlined in the program, this specific conference deals with 3 core themes. The first among them is the evolution of the financial sector since the great financial crisis, varieties of finance that have been proposed for climate change, and the emergent risks through a Minskyan lens. We also want to talk about the crisis of working America, and we'd like to connect economic grievances to political outcomes. We'll also talk about the resurgence of the pay-for myth. And finally, we want to talk about the global economic reordering from trade realignments to alternative development models. But as we move through the day, I want to touch on 3 topics that don't fall under a specific rubric, but they provide additional context for our discussions. And the first of these are the structural fissures that continue to endure in the US economy as well as in the global economy. And I think it's fair to say that many families are beginning to understand that the economy isn't just failing them, but it is actively working against them. There's a powerful alliance of Wall Street and Silicon Valley interests that restricts their options at every turn. We have private equity firms controlling hospitals, inflating costs of care, mega monopolies dominating grocery stores and utilities, institutional investors controlling a larger share of rental markets, and AI algorithms which adjust prices in real time, profiling consumers, squeezing every last dollar during peak demand, and worker monitoring algorithms, replacing human judgment with opaque decision-making. So I think in this context, it should not be a surprise to know that during election year in 2024, 56% of Americans believed that the US was in a recession, and 49% believed that the unemployment rate was a 50-year high, even though it was near 50-year low. The economic data no longer tells us how Americans experience the economy. Mainline numbers of growth, of low unemployment, don't change their sense of economic insecurity or instill confidence that they can get ahead. So I'd like to suggest that this is not a phenomenon of misinformation. This really is, it's not even vibe-session, if you recall what economists termed it just a couple of years ago. This is really the result of a very long-standing decline of the American middle class. Today, 58% of Americans earn less than $25 an hour. 58% less than $25 an hour. Meanwhile, there are new risks brewing in financial markets, many again related to private equity, crypto, tech, AI, and at Levy we're focused on understanding the evolution of the post-2008 financial order. Now you recall our distinguished economist, the late Hyman Minsky. He talked about tipping points. He talked about how when finance moves from hedge to speculative to Ponzi, we then see the manifestation of crisis. But I don't know how many of you know that there is a second Minsky. There was the long period Minsky. The Minsky who talked about the development of the capitalist economy through phases, from merchant capitalism in the late 19th century to welfare state capitalism in the post-war era to today's international money manager capitalism. It is in these long waves of structural change that we can find the new forces of instability. So that's the first topic I wanted to touch on. The second one is the homegrown, American-made, self-induced paralysis of the administrative state. We're witnessing a sustained dismantling of government agencies, and those very hollowed-out agencies lack the capacity to enforce regulations, to respond to economic shocks, or even to reliably process citizens' basic needs. This is not efficiency. This is unilateral disarmament in the face of complex global challenges. And it is entirely unclear if the government is willing or even capable to orchestrate the kind of coordinated policy response that it launched during the COVID pandemic. Now again, recall in Minsky, you recall that he said, during crisis, however necessary, governments must respond, even if they embed moral hazard in their responses. But respond they must. And I think today, maybe for the first time, we can ask ourselves the question, will the government respond? I mean, this has never really been up for grabs in the post-war era. Maybe the response was misdirected. Maybe the response was ineffective, but governments have responded. Will we have the tools and the capacity to do that after Doge has slashed the administrative apparatus? Finally, I'm going to conclude with a third topic, that we still face very many orthodoxies that stunt progress. I'm going to just highlight two of them. The first one is the NAIRU, the non-accelerating inflation rate of unemployment, that cruel insistence that we must use unemployment to control inflation. When the post-pandemic crisis rose, economists rushed to advocate, you may recall, for draconian measures, high sacrifice ratios, basically job losses to fight inflation, despite clear evidence that price spikes stemmed from supply shocks, corporate profiteering, and not from wage growth. By some miracle, the labor markets avoided collapse as the Federal Reserve was aggressively raising interest rates. But don't mistake survival for well-being. We at Levy have developed an alternative to the NAIRU. A program for stabilization that does not sacrifice jobs, nor threatens price stability, and this is the federal jobs guarantee. The second broken orthodoxy we must vanquish is the pay-for myth, the lie that there is no money for public needs. Every Doge initiative has used this excuse, and let's be frank, every politician, whether Republican or Democrat, at some point or another, has used the debt deficit myth to criticize the opposite party. It's time to stop this folly. The 2008 bailouts, COVID relief, endless wars, tax cuts, no-bid contracts, corporate subsidies galore, they teach us one thing, that the government is self-financing, it creates its own funding, and it cannot run out of money. Before I open the conference, I really want to thank my fantastic team for doing this, for organizing this event, for putting this day together. And in particular, I'd like to single out Managing Director Michael Stevens and staff members Laura Zotel Angioletti, Lindsay Carter, Tyler Emerson, Shane Ray, and the fantastic graduate students of the Levy Institute master's programs. We are in the business of not just studying the economy, but also reimagining it, and we are training the next generation of economists and policymakers right here at Levy. So thank you for your hard work. Welcome. I hope we're going to have a productive conversation that cuts through the chaos and busts broken orthodoxies. Welcome again, and let's get to work. Okay, so I'd like to invite the first panel to join me on the stage. Please refer to the program for bios of the presenters. The first panel is on financial, on the evolution of finance. And I guess one of your program purchase subset, and I ended back to Joe. Okay. All right, I'm going to introduce the first panel, and then we can, we're going to have the moderator is going to be Talmon Smith from the New York Times. Talmon, if would you like to do it from the seat or from the podium? I just would like to urge I'd like to urge the presenters to please come to the podium because our timer is here. And so I'd like to ask you to press this. Well, when the first person is ready to go, we just do that.
Okay, cool.
I'm not sure how I do that. Okay, I need a tech person to show me how to start the timer.
Oh,
he started. Okay, thank you. Okay, great.
All right. Morning, everybody. That's sweet. All of out your second cup of coffee, huh? All right. Good morning. There we go. Thanks so much for coming. Thank you so much, Pavelina, for having me here. And thank you to the Levy Institute. I'm Talmon Smith. You can just call me Tal. I work for the New York Times. I'm an economics reporter there. And I'm actually on book leave right now. Folks have asked me whether I feel FOMO because of this crazy news cycle. I say no. It's actually kind of nice to have a break from it and to be thinking about the sort of structural things that we are thinking about discussing today. And two things have come to mind. One, sort of how, despite Minsky being known for the stability breeding instability hypothesis, for the last 15 years or so, we've been in recession for a total of 2 months, give or take, right? That spring of 2020. And yet, we know, as the theme of the panel indicates, that Minsky was able to tell us about so much more than just the stability breeding instability hypothesis. And so we have 3 brilliant panelists that will be walking us through that. And I will mostly just be a wallflower and sort of just arranging activities and then eventually the Q&A. And so with that, do we have Dan, are you first, or Leila, or Rogerio? Dan, how about you?
I'm going to start this off on a bit of a down note, I'm afraid. But Pavlina was nice enough to mention the capitalist development theory that Minsky was nice enough to bless us with. Do I have slides? Ah, there we go. Thank you. You can go to the second slide. So it's my opinion at this point that the U.S. is really flirting with a transition from the money manager capitalism phase that Minsky wrote about to something else. And I think it's worth, can I have a second slide, please? I think it's worth thinking about what Minsky was, what Minsky was telling us. Okay. Is anybody operating the slides? Oh, I am. Very good. Nobody told me, you know. Okay, great. Good. Sorry. In any event, towards the end of his life, he observed that the next transition in the development of capitalism would go one way or the other. And one way was a fortress-like oligarchic limited democracy. The other one would be, of necessity, a shared prosperity détente between capital and labor, that hopefully would perpetuate our existing liberal democracy. All of this, if you study the history, came from or originated with his being mentored earlier in his life by Joseph Schumpeter, who also felt that capitalism wasn't going to be with us for the long term. He was not necessarily a Marxist, although he certainly respected Marx, and didn't think that we were going to have this uprising of a proletarian revolution, but Schumpeter felt that eventually capitalism would result in entrepreneurs' initiative being offset by the desire for stability, risk aversion, and the like that would come with the formation of large firms. Minsky, as we know, thought something beyond that, which is that financialization, the concentration of wealth, would develop into a Keynesian casino-like economy, and that underinvestment in capital goods of wealthy nations and therefore stall growth and social instability. And I think that's pretty much where we are today. I'm just finishing up a paper that's going to review all of this. It's going to talk about what happened after Minsky passed in terms of developments in the capital markets and global macroeconomic changes. We're now forced to confront the reality of the existence of a economic nationalist agenda that has been put forward as a way of potentially solving the problem. And then I'm going to talk a little bit about today. I want to talk a little about the battlefield, money manager capitalists versus the economic nationalists, who I think are really in opposition to each other. As you can see, I'm going to suggest that we are heading towards a Minsky moment version 2, which is based on all of the stuff we've just talked about, and then I'm going to think about what emerges. So for those of you who are not familiar with the capitalist development theory that Minsky put, this is the theory in a nutshell, running from merchant capitalism to industrial capitalism, banker capitalism, managerial capitalism, which is what I was born into, and those people who are here near my age were born into. And then the phase of money manager capitalism that he marked as beginning in 1982. I'm a little bit sort of forward of that, maybe the early 90s. And what he saw at that point is, the focus on the financing of the corporation, not being the primary issue, and then moving towards money managers who were bringing in capital from mostly insurance companies and pension funds. And I'm going to bring, because I am from Wall Street, I'm going to bring a little bit of Wall Street bent to this. Money that was coming from very, very large institutions in gathering those funds and then managing them. Roughly speaking, that was the tip of the iceberg, because what happened later, I think, is even more profound, and this is how I describe it. I separate the money manager phase into early day money manager capitalism. Again, those pension funds, insurance companies, mutual fund capital flowing to managers. And then what we have today. And what we have today is far more extensive. Large money managers expand their beneficiaries to include families, foreign assets, expand the asset side to include literally everything. They're not just investing in stock portfolios and bonds, they're investing in everything: private equity, VCs, private credit, consumer loans, banks. Volcker famously said before he passed away that banks have been relegated to being an ATM tied to a mortgage originator. They have no balance sheets with risk assets on them anymore. They move those off into the capital markets. And so that's a very, very important distinction, and one that Minsky, I would argue, really didn't live to see. So what does that mean as to where we're at right now? This is the next two slides, this one and the next one, really describe things that have happened since Minsky. First of all, we've had the continued evolutionary shift from corporate responsibility, to multiple stakeholders, which, arguably, came with the rise of the Business Roundtable's famous paper where they said there's only one thing that matters, and that's the shareholder. That has persisted, notwithstanding what came out after the pandemic or during the pandemic, where suddenly they got religion and said, oh, we still believe there are multiple stakeholders. They weren't really serious. And so the money manager capitalism, the one thing that Minsky was absolutely correct about was that the only thing that was going to matter going forward was being able to produce short-term returns for money managers. But then, of course, that resulted in the co-option of managers themselves, business managers, via direct financial incentives. Just think stock options is probably the easiest way to think of it, to effectively bring them along into supporting that. The compensation model of money management at firms, this is probably the most important issue here. You think of money managers as trying to maximize returns for their beneficiaries. In fact, what they're trying to do is maximize assets under management. And that's probably the biggest thing that has changed since Minsky. What they're doing, it doesn't matter what sector you're in, they're being paid a fee for actually receiving assets to manage. That base fee, if you run, $5 billion, you wake up every day making excuse the expression, shit ton of money. And when you do that, it really doesn't matter whether or not you hit your bogey and are able to participate in profits. You are incented to simply gobble up more and more assets. And that is the big distinction that Minsky didn't see yet. And that's where we're at today. Therefore, the holdings of most money managers in any given sector must align with their competitors. And that's a really complex concept if you think about it. If my goal is to accrete assets to manage, so I get that nice little fee in there, well, what I'm really trying to do is not do worse than my competition, right? I'm not trying to do, I'd love to do better, but I don't want to do worse. And so I have an enormous incentive to align my holdings with the holdings of everybody else. And of course, if you look at the public equity markets, putting aside all other things, if you look at the public equity markets, you see that immediately in the 10 largest stocks comprising an enormous percentage of the total holdings. So you are in that situation where you have really, truly, in my opinion, corrupted capitalism through this method. So the result is that the latter-day version of money manager capitalism essentially has business proceeding on autopilot. You've actually slashed through the traditional concept of governance of firms, right? If you can't walk away from a holding because all your other competitors hold that same stock, well, you can't apply any corporate discipline to management. Therefore, management's going to go and take whatever risks they want. They're going to, potentially flush through tons of money, burn through tons of money, accrete, as in with Apple, huge amounts of money, and not put them to use. And that's a condition that is really a complete degradation of capitalism. Now, at the same time, I'll remind everybody, the pandemic really threw us off the rails. I think Helena was really good about talking to that point, but we're back. We're back facing the fact that we still have a capital glut globally. I don't like using Bernanke's word capital glut. I prefer excess of capital relative to demand, because that's the condition that we've had now for 15 years, more than that actually, 20 years. Notwithstanding the availability of capital, we have the consolidation of production into fewer established entities into which capital can be deployed. Persistent excess of global production relative to aggregate demand. Again, people got they got distracted during the pandemic, and they saw these these supply chain shortages. They saw this massive inflation. They said, "Oh, this is all over. We're going to be back in an era of inflation," and they were dead wrong. Where we're at right now is, just look at China. Notwithstanding Trump's, running around and trying to put tariffs on everybody to stop this condition, which he will not be successful in, and I'm willing to speak to that later. The fact of the matter is that you have, barring that, and not to say that I approve of the policy, but barring that, the truth is that China is dumping rampantly all manufacturing economies and surplus economies are dumping all over the world because that's the only act they have left. They've built out their infrastructure. They've gathered in demand for 10 years out and brought that forward. They really have nothing left other than to go back to the export sector. And then, of course, whether or not I'm certainly open to comments from folks who knew Hai, but whether or not he envisioned the post-Cardian environment that we're in, where everybody can make everything, right? I don't know. Randy, you may have a thought on that, but I'd like to, explore that as well. So, two things that just a little bit of a victory lap. The age of oversupply is still with us. That was the name of my 2013 book. And moreover, inflation, yes, was transitory. It just took a little while. Now, what's going on with labor and what's going on with this enormously grievance-ridden population of the United States? Well, they're grievance-ridden for a very good reason. This is a graph of labor share. It's indexed to 100 on the left side. Look what happened. I don't really need to say anything more. Again, this is capital share of production. Look what happened. Now, there's slightly different databases of necessity because of the way things are reported, but it's basically the same point. These two slides, I think, tell an enormous story. We are producing stuff. We have growth, arguably, in our economy, although this year I believe we won't. But nevertheless, the benefits of production of the United States economy are flowing to capital in a way that is not sustainable if we're going to maintain any sort of social harmony. Just a side note on immigration. Just look at the left-hand graph for a second. That's the Hispanic population, and it is offset against the white population. As you can see, the Hispanics are the red. As you can see, for the first time, they are employed at a higher percentage than the white population. This is, a positive, I think, because they represent a very important group of growth for the economy. But as you can see, the white population is not very happy about that. And moreover, if you look to the right side of the obvious issue is we have no population growth. So that's a big thing. And there is an index that I created in 2019 that's published by the University of Buffalo. It's called the private sector job quality index, and all it does is it sets the number of jobs that are high wage, high income, high wage, high hours, low wage, low hours, and it determines the ratio between those two. It looked like we were improving for a while, but I'll give you advance notice, the numbers just rolled over and we're heading back down again. And so that's not a good thing. If you look at the jobs that are being formed today, they are, last month for sure, they are all in the low wage, low hour category. And that is not a great thing. So add to that burden transfer. Now this is very important. It's on the fiscal side, right? But I think it's very important to keep in mind, and I've tried to lay out. Could I have a glass of water if you don't mind? Anyone will do. Thank you. I've tried to lay out what the chief ones are that I see. Obviously, healthcare, underfunding of public schools, education, in higher education, worker training. 80% of households say they're financially struggling, risk of falling into economic insecurity. And now we have Gen Z coming along, which, notwithstanding the fact that they're a pimple on the ass of the elephant from an asset side, they are huge in number. And so they are, they are incredibly pessimistic, probably are not going to spend very much money, and that is going to be a headwind to the economy going forward. So the battle is joined. We have both the populist left and the populist right assembling large followings with messages and policy proposals that attempt to rectify this and attempt to rectify the economic breakdown of society. Both groups face a common foe in the money manager capitalism elite and its beneficiaries. The populist right is particularly in a difficult bind because its politicians are heavily supported by those who benefit from the status quo. That's where their contributions are coming from. And it's very, very hard for them to implement policy that is going to strip money managers of their prerogative. And I'm not talking about money managers in the sense of the guy who's actually managing the money. I'm talking about an entire ecosystem. And that is going to be very, very difficult. On the left, we have an alignment between the left populists, economic populists, and the left culture issues, which, as we know, is not getting us anywhere because a large portion of the population have some difficulty with those culture issues. It's very difficult to imagine that the Trump administration's experimentation with the unitary executive, authoritarian actions, and potential non-compliance with the judiciary are not going to provide a roadmap for an illiberal democracy. I mean, that's what I believe we're looking at right now. And so the lines of resistance are not yet established. We had those King rallies over the weekend. That was nice. 2,000 different rallies around the country. I don't know that that means anything because they lack power. I do believe, therefore, that we are facing a Minsky moment V2. The second time this century where his warnings need to be taken seriously. And so where does that bring us? That brings us into the two possibilities, the two outcomes. One is this fortress oligarchy where those who want to continue the status quo effectively end up suspending the rule of law when necessary, continue to dominate the electoral process with things like Elon Musk giving $250 million, but I could go on. You continue this, kleptocracy. The kleptocracy is very useful because if you can, suspend the enforcement of law to allow people to engage as kleptocrats, right, inside the government, you then actually create a better and more fertile environment for a liberal government. So I'm just looking at the clock. I think I'm down to 1 second. The other alternative, obviously, is a shared prosperity economy where collective action solutions to common burdens are implemented, a greater role by government in the economy persists, state-assisted industrial policy, progressive taxation, support for family growth, and immigration reform. With that, I will stop, and I thank you.
And next up, we have Leila Davis from the University of Massachusetts.
Do I start this timer over? They'll start it for me. Okay. All right, well, thank you. Thanks for the invitation. It's great to be here. I'm going to turn today to talking about the non-financial firm part of the economy. And I'm going to talk in particular about the evolution of financial fragility in the non-financial corporate sector. Okay, I'm going to do this specifically from a Minskyan perspective, wherein I'm going to look primarily, in most of what I show you today, at an empirical mapping of Minsky's concepts of hedge, speculative, and Ponzi finance into US firm data, specifically US non-financial corporations, since 1970. So I'm going to do this with a reasonably long-term lens. I'm going to go back to 1970 in most cases, sometimes a little bit further. And I'm also going to do this using, as I said, firm data, which means that I'm going to be able to talk about things like entry and exit and sector, which provides, I think, some insight into this distinction that was raised earlier about thinking about cycles via individual firms switching between hedge, speculative, and Ponzi finance versus longer waves of fragile or increasingly fragile norms in the US context. So the main sort of big picture takeaway that I'm going to show some evidence for today is that there is evidence of a long wave of increasingly fragile financial structures in the US non-financial corporate sector. And I'm going to show about 4 pieces of evidence that support this claim that I'm going to make. So first of all, I'm going to focus on the share of Ponzi firms, and I'm going to show that there's been a trend increase in the share of firms with Ponzi financial structures after 1970, and actually really since 1980 is when the change starts to take place, such that by 2024, about 1/3 of US corporations have these Ponzi structures. The next thing that I'm going to do is take some time to break down some of the things that are underlying this trend. So the second thing that I'm going to do is I'm going to show that this trend increase in the share of Ponzi is closely tied to an increased incidence of firms that in fact have negative profits. And this means that even before I turn to their financial obligations or look at the liability side of firm balance sheets, we're seeing that these are firms that tend to be Ponzi. And for this reason, I'm going to focus primarily on profits or sources of funds in what I talk about today. Although you can also see that Ponzi firms, for example, do, as you would expect, become increasingly indebted and unsustainable over time. The third thing that I'm going to do is I'm going to ask the question of where Ponzi firms come from, in effect. And I'm going to show that firms have increasingly come to enter the non-financial corporate sector or the world of publicly traded corporations with Ponzi structures. And this is important because it means that this rising trend of Ponzi structures that we see among US non-financial corporations is not really a feature of firms that tend to, for example, respond more aggressively to business cycle downturns than perhaps they had in the past, of firms cycling over more and less fragile states. But instead, this is a story of a long-term shift in how we think about firms actually accessing equity finance in the US case. And then the last thing that I'm going to do is I'm going to raise the question of sector. And I'm going to ask in particular if really what I'm showing is a story of structural change, wherein more fragile types of sectors or sectors with these types of financial arrangements have gotten bigger. And I'm going to show that this is, or I'm going to say that this is not the case. And in fact, when we're looking at this rise in Ponzi structures, this rise in financially fragile structures, we're looking at a story that really is taking place across macroeconomic sectors of activity in the US. And so together, these pieces of evidence point to a story in which we see a long wave of increasing tolerance for fragile structures in the US economy and for thinking about changing norms about what is in effect acceptable for firms to look like when they enter this world of publicly traded firms. All right, so I'm going to take a couple of minutes, although I think it's well known to a lot of people in this room, to set up some of the concepts of fragility that I'm going to talk about today. So my starting point, the framework that I'm going to use for thinking about financial fragility and for defining it for US firms, is the financial instability hypothesis. In this framework, the degree of fragility is cyclical, and stability breeds instability, such that a larger share of fragile agents makes the economy more vulnerable to shocks. So it's important because it means you have a more fragile economy. In turn, the degree of systemic financial fragility can be described by the distribution of units into 3 financing regimes, and I'm going to hold fairly closely to these regimes in what I show you today. Hedge units are the most financially robust. These would be firms that have expected cash flows that are sufficient to cover both their interest and their principal obligations. Speculative firms are relatively more fragile. These are firms that, as you know, need to roll over their principal payments. And then Ponzi firms, which is where most of my interest today is going to lie, are the most fragile. These are firms that are going to need to roll over both interest and principal obligations, and therefore are going to become increasingly unsustainable over time. What I'm going to do is map this schema into US firm level data, and I'm going to do this following some work that I've done with my co-authors João de Souza and Gonzalo Hernandez, where we look at financial fragility from this Minskyan perspective. And what I'm going to do is I'm going to compare firms' net sources of funds to their required debt payments. And when I talk about sources of funds today, I'm going to be thinking about sources of funds that are net, for instance, of wages and salaries. This is going to look a lot like operational inflows. I'm also going to be thinking of sources of funds that are exclusive of funds that the firm can acquire, for example, from new borrowing or new equity issuance or other types of new sources of funds that come into the firm. So I'm going to compare these relevant sources of funds, these sort of really what aligns closely to net operational income in quantitative terms. That's what dominates sources of funds. And I'm going to compare it to required debt payments, where I'm interested in interest and principal obligations that come due in that specific year. So those that are obligatory in that year. And by way of defining my scope, I'm looking at listed US non-financial firms, and I'm going back to about 1970. All right, so the first thing that I want to show, and this is sort of the main headline pattern that I have to share with you today, is the shift in the composition of the US firm sector towards Ponzi firms, where we see that by the red line that there's an increased share of firms with Ponzi structures, such that by 2024, about 1/3 of US firms are Ponzi. Again, this means that 1/3 of US listed firms are unable to cover either their interest or their principal obligations on the basis of their current income, which is, I think, striking. This growth takes place, first of all, during the 1980s and 1990s. This is a period of rapid listing in the US non-financial corporate sector. And then again, there's a second period of, I think, fairly notable growth that takes place again after 2010. When you look at this trend, you see that the rise of Ponzi comes in effect at the expense of speculative firms, whereas the share of hedge structures is pretty stable over this full period of time. All right, the next thing that I'm going to show you is a little bit about what firms these are that tend to become Ponzi, and in particular, I want to note that these tend to be smaller firms. These are still listed firms, they're still big, but within the non-financial corporate sector, it's the smaller ones. So I'm showing you firms, first of all, in the bottom quartile of the asset distribution on the left, and in the top quartile of the asset distribution on the right. And again, I'm showing the distribution or the shares of firms that fall into each of these 3 financing regimes. We see that the share of large firms is really very steady by financing regime over time, such that the growth that I'm showing you lies in the bottom quartile, and in fact just is concentrated more generally in the bottom part of the asset distribution, such that by 2024, we're looking at almost 80% of these smaller corporations that have these Ponzi structures. All right, so why are these firms Ponzi? As I mentioned, I can talk about these firms as being Ponzi even before I turn to the liability side of their balance sheets. And that's because what we see at the same time is an increasing share of small firms, or firms in general, with negative sources of cash. Here I'm going to show you small firms. So I'm going to focus on that group of small firms from the previous slide, which we know intersects very closely with the trend increase in Ponzi, in the incidence of Ponzi. And these are firms that in 1970, less than 20% of them had negative sources of cash, and this is rising to about 3/4 of small firms that have negative sources of cash by 2024. What are these negative sources of cash? This is a little bit of an ambiguous thing I'm saying. A lot of different stuff can go into the sources of cash. Well, the main thing that I want to emphasize that's quantitatively important here is funds from operations. So I'm looking really at some sort of thing that we can think of as fairly closely aligned with a measure of net operational profits. And again, we're looking at 77% of small firms have net negative operational funds from operations by 2024. If I were to focus specifically on Ponzi firms, this rises to above 90% by 2024. And so what we're really looking at is something that's happening in terms of those sources of funds, where these are firms that are now able to exist in this sector with negative operational income. These negative sources of funds align very closely with what we know has happened to the profitability distribution in the US non-financial corporate sector as well. So here I'm showing you the 20th and the 50th percentiles of the profitability distribution. The 50th, the median is in blue. I have that just for reference. That looks pretty steady over time. And what's happening is, this graph goes back to 1950, is since about 1980, we see that the bottom of the profitability distribution has pulled away from the median. So these are firms at the bottom of the distribution that are now operating with negative profits since about 1980 and are performing increasingly poorly in terms of their profits, both relative to the median and, as these profits are increasingly negative, also in absolute terms. All right? So why do we see that the bottom of the profitability distribution has, in effect, sort of fallen through the floor in this way? There are going to be a lot of reasons, but the one that I want to focus on has to do with entry, and then I'm going to tie this back to Ponzi firms as well. So one important feature of this decline at the bottom of the profitability distribution that I think is really noteworthy lies in the increasing prevalence of negative profits among new cohorts of entrants. So what I'm going to show in this slide is a little bit different. I'm going to show you average profit rates by cohort. So what I have up on the slide right now is all firms that entered in the 1970s, and you can see that their profit rates over time are positive. They're fairly steady. Maybe there's a slight rise if you're looking at the 1990s. Now, if I bring in subsequent cohorts, we're going to see that there's level shifts down over time. So now I've introduced firms that entered in the 1980s, and I'm looking at their profit rate over time, which for most of the period is still positive, although is negative in a number of years upon entry. These are averages. You do see that there's an increase in profitability among the firms that entered in this 1980s cohort over time. I'm not going to talk a lot about exit today for the sake of time, but I do want to note that a lot of that trend increase reflects the exit of the most unprofitable firms, rather than sort of life cycle effects wherein these firms sort of get on their feet and do increasingly well as time progresses. And nonetheless, despite that trend, we see that there is this negative level shift. Their profitability never reaches the cohort before them. Now, if I introduce firms that entered in the 1990s, we see a similar level shift downwards. We start to see a longer-term incidence of negative average profitability among these firms. And when I introduce the most recent two cohorts, we see that the trend becomes, I think, even more dramatic. Firms that enter the non-financial corporate sector after 2010 seem to have basically persistently negative average profitability, and that is most dramatic in the most recent cohort. And this graph only goes up to 2017. All right, so we see that there are more Ponzi firms, that Ponzi firms tend to increasingly have negative sources of cash, that this aligns with evidence of falling profits, especially among new entrants. So I want to tie that back to Ponzi, and I want to now ask specifically the question of how firms become Ponzi. And we know that a firm can become Ponzi from a number of different prior states. A firm might become Ponzi because it was previously hedged, and it faced a negative shock, and it became more fragile, whether to profitability or whether to its financial obligations. The same could happen from a speculative state, or of course, a firm could simply go public with a Ponzi structure. So I'm going to bring each of these up in turn to sort of show a lot of information in a short period of time. So here I have the share of firms that became Ponzi from a previously hedged state. This share is small, which I think is unsurprising. And it never really rises above 10%. There's no trend over time. So there are some transitions that are happening from hedge to Ponzi, but not many. Speculative firms are important here. Speculative transitions do matter. However, their share is declining substantially over the period that we're talking about here. So we see that the status of firms that were speculative in the year before transitioning to Ponzi goes from a clear majority in the early years of this sample. So most firms in 1970 that became Ponzi were previously speculative, to about a third of firms that are becoming Ponzi since 2010, really. And of course, what that implies is that the converse is true for the role of entry, that firms that are becoming Ponzi because they enter as Ponzi, and this is consistent with entering with negative profits, has risen markedly to reach more than half of Ponzi firms by 2024, by 2020 to 2024. And so the role of entry is an important part of what's going on here. And this matters a lot because it's a very different type of story about fragility if we're seeing that individual firms are cycling back and forth, that the cycle happens within the firm. For example, if the cycle happens within the firm, then the policy guardrails that we might be thinking about would also apply to the individual firm. Instead, what's happening is something that seems to be much more a story about accessing the sector, much more a story about changing norms, again, to repeat myself from earlier, about what is acceptable for a firm to look like in order for it to be in the world of publicly traded firms. All right, I have 4 more minutes. I'm going to show 2 more things. So I want to show one more sort of piece of evidence that speaks to this point about a long wave of changing norms versus fluctuations or cyclicality within firms. And I want to consider the role of the business cycle. And I want to ask in particular, okay, well, is there a meaningful short-run effect of the business cycle and of business cycle fluctuations on individual firms' fragility? And in order to answer this question, again, with my co-authors, we've estimated the relationship between measures of macroeconomic performance, whether it's the cyclical component of GDP or GDP growth or other types of measures, and the probability that an individual firm is Ponzi or becomes increasingly fragile, transitions into Ponzi. And when we look at these types of estimations, we see that the direction of change is what we would expect. So business cycle downturns do raise the likelihood that individual firms are financially fragile. That makes sense. However, the size of the effect is very small, and so small as to be economically effectively not what's sort of driving in any meaningful sense the long-term trend that I'm showing in terms of the share of Ponzi. So to put some numbers on it, a 1 standard deviation decline in real GDP growth, for instance, is associated with a 0.7 percentage point increase in the probability of being Ponzi. This, again, is in the direction I would expect, but I would say that 0.7 percentage points is quite small when we compare it to an unconditional likelihood of being Ponzi of 17.5%, and that's over the full period. Of course, that share rises substantially by the end, by the most recent years. And so, again, to speak to this question of sort of shorter-term cyclicality versus longer-term waves, this shorter-term cyclicality wherein firms get hit by business cycles and therefore have this cycle among different levels of fragile states is not really the main driver underlying the patterns that I'm showing you today. All right, the last thing that I want to raise is the possibility that this is a story of structural change. So one reasonable hypothesis would be, I think, to say to me that it's very likely that the rise in the share of Ponzi really simply reflects something different than what I'm kind of emphasizing. It reflects structural change. For example, the growth of high-tech industries or of information and communications technology industries, and perhaps these sectors are simply more likely to have balance sheets that look this way or cash flows that look this way. And therefore, when these sectors get bigger, the share of Ponzi in the economy is bigger. And it's not about norms, it's simply about sector. The main thing that I want to say is that this is not what's happening here. And in fact, Ponzi structures have grown across major macroeconomic sectors of economic activity. So yes, they grow in, for example, information and communications technology, but it is not specific to those sectors. And in fact, if you look at sectors, you see, especially in the 1980s, that the changes are positive within all sectors, and thereafter positive or occasionally fairly small. So what I'm showing here is a decomposition of the decade-by-decade percentage point increase in the share of Ponzi firms. So you see in the decades that it grows, it's about 10 to 15 percentage points of increase per decade. And I'm showing how much of it in blue comes from the fact that within sectors, holding their sector size constant, these sectors see more Ponzi firms. And the tinier part that I show in red is showing the effect that comes from the fact that high-level Ponzi sectors get bigger. And the pattern is clear. This is a within-sector story, and it's, again, sort of speaking to my overall claim here that what we're seeing is a really widespread shift in norms. It's not about sector of activity. It's about entry and how we think about access to the non-financial corporate sector being organized. All right. So by way of sort of repeating myself for my last few seconds of conclusion, I think I've shown some evidence of an increasing wave of increasingly fragile finance among listed US firms. The share of Ponzi firms has risen, This is small firms that list as Ponzi and have negative profits. And in terms of interpretation, I want to point to the role of changing norms about who gets access to equity finance, wherein institutions that determine this access have disseminated changing norms about what, again, is acceptable in terms of profitability to be a listed US firm after 1970. Thank you.
Leila, thank you so much. And next up, we have Rogerio. Come on up.
Oh, the clock is here. Well, good morning, everyone. I want to start thanking the Levy Institute for this invitation. It's truly an honor for me. I've been a development economist for at least 40 years. And coming back to talk about development economics here, particularly when paying tribute to Minsky, is very dear to my heart, and you understand why. I think that it has become clear to all of you that I'm going to be talking about a completely different subject here. But I think it may be interesting, particularly for those who are at the moment in the same position that I was 30-some years ago. In my case, I was a young economist dedicated to the issue of fostering social and economic development. In my country I was born, in Brazil, the issue was how to, first of all, it was a moment, most of the region where I come from, coming from dictatorships and authoritarian regimes and going into democracy and trying to figure out how you could transform an economy that has been very unequal, and very concentrated in power into something more just for the future. So at that time, and this is, I think, it's a position of a lot of young people here, and actually I'm going to be talking more to the young economists, hopefully, that are trying to figure out in a world where so many things have got to be done and transformed, how you even structure your thinking around something simple that you can dedicate the next 20 years to become hopefully useful for this transformation. At that time, the only way you saw, and I became a financial expert. I started my professional life in a bank, and then I became an academic. But my issue has always been finance and development. And at that time, the prevailing view, which came basically from the multilateral institutions such as the IMF, World Bank, but several, even the academia, was very conventional in the sense, not even conventional, but as I perceive now wrong, that the main constraint for development for mobilized resources was savings. And the idea that you have to increase savings in order to get higher levels of investments and transformation. That was a puzzle for all of us because we saw in history that was a completely different thing, and also because of the development examples that we had at the time, for instance, coming from East Asia and from China, was that it was a little bit different from that. What you had is a very rapid increase of financing that resulted in the investments and therefore the savings that will supposedly require. For there was a problem of causality there, how to get the position of mobilizing resources to promote transformation. And to make a long story short, I had a Marxist background, which I still keep some of that, particularly the idea that we need transformation, but that's another story. But I could not find in the literature something that would guide me to something different, and believe it or not, that's when I discovered Keynesian economics, particularly Keynes in the discussions, and his early discussions of the monetary production economy. And it struck me as something very simple what he was saying. The problem is not savings, it's providing liquidity for investors in order to start the process, which he called investment multiplier, that resulted in the savings that were going to be allocated properly for funding. So his first issue was, how can you reduce liquidity preference of first banks, which can create the liquidity necessary to finance investments? And once you do, or how can you reduce liquidity of those holding wealth, which in developing countries then and now developed countries are one of the main important players in creating finance, how you induce that in order to start the process. He was questioned about that by conventional economists, and he came to the position that, because they were saying, well, what do you do with the savings afterwards? What's the purpose? What is the purpose of capital markets? Remember, the conventional view was that you had to increase savings. How do you increase savings from the point of view? The conventional view was by liberalizing finance and the capital markets, and out of the blue, there's going to be a burst of savings coming out of the system. And so that was the same kind of approach that Keynes had from from people discussing. He would say, well, funding is important because that provides the matching, reduce the financial fragility caused, and that Minsky explored very much, that is caused by the fact that you're financing something that is short-term with bank finance, but you want to finance that is long-term, which is investment. Somebody has got to carry that financial risk. And so he explored that a little bit by talking about the role of capital markets in funding, what he called funding, and it seems to be appropriate. The second person that impressed me a lot was Schumpeter. It's interesting, Schumpeter, he was talking about financing innovation. He was talking about financing transformation. And development is all about transformation now here and in any developing country. So, but the third person, but that's another story. By the way, Schumpeter wrote a book called, which I read recently, on money, that he decided not to publish because he thought Keynes' treatise on money was much superior. But that's another story. I think that his book is exceptional. The third person, of course, was Minsky. Minsky's approach was very interesting to discuss that because he is posing an additional question, which is, what if financial, when the process of increasing investment, you increase financial fragility, and that leads to a crisis. He said that stability, as you mentioned before, stability drives towards financial fragility and therefore financial crisis, which for developing countries was some very important point, because what we observe is that financial expansion, rapid financial expansions, often had to balance our payment crisis or in domestic financial crisis. So here there I start. Do I have already 13 minutes? No, this is wrong, right?
I think it's counting down.
Oh, it's counting down, thank God. Okay, so here is where I start, okay? And this is, my idea was very simple when I came here, which was this. Let us give a broad perspective for the young economists that's trying to organize the ideas of thinking of transformation. And transformation is so much needed, not only in developing countries, but in developed economies. About 15 years ago, I first read my first report on climate change. So that's when hit my head. We're not going to have development, or even our existence threatened by climate change. So you have to mobilize resources in an incredible way in order to promote the transformation that would lead us to a possible future that can allow development. I decided to dedicate the rest of my my intellectual life to addressing the issue of transformation. And I think this is, compared to what I had for 40 years ago, or 30 years ago, is exactly the same issue that a lot of young people are asking. If we don't have any other more serious crisis, believe it or not, this is the world that we live in. The biggest threat that we face, both developed and developing countries, is climate change. Have no doubt about that. So I thought, so how can I still use the same framework, Keynes, Schumpeter, Minsky, to do that? To think about this, the mobilization of resources needed for this transformation? Unfortunately, yes and no. We have to go beyond. And what I'm going to present to you here is how far beyond we have to go. And I'm sorry to give you that perspective because I'm not going to give you any answers. My idea here is, as Pavlina said, and I apologize for, but I misunderstood the schedule here. What I'm trying to give to you is one way of thinking ahead, but unfortunately, you guys have the task of doing that, not me. Too late for me. Okay, so first of all, why action is needed? Let's think about beyond the imperative. I've been in this climate action agenda for a while. There's a tendency for us to do a lot of advocacy. This has got to be done, okay? So it would be the same thing as 30 years ago saying development has to happen. Why does it have to happen? And what are the tools to make it happen is what is the difficult questions. And I think that we as an economist, we don't have all the answers, but we can organize our thoughts around some possibilities. So the first thing is, you all know, please do not focus on the PowerPoint, otherwise it becomes powerless and pointless. It's focus on the ideas. I'm using that just to organize my own thoughts. I promise I'll share this with you. We all know where I think I need to get my water. I get very nervous when I speak in public, as you can tell. Okay. The science we all know. We are facing a tremendous increase in speed. Acceleration of climate change, and the scientists were perceiving this to be even slower than what we observe now, and the consequences of that have been extraordinary. If I can move this thing. Okay, the causes we all know, there's a huge concentration on the fact that we produce energy and we move commodities, people, whatever, using fossil fuels energy. A significant part of climate change has got to do with carbon emission, not all of that, but certainly it has associated with a way of producing energy, producing good, and transporting people and commodities that is based on killing the planet. So this is, yes. The consequences are there for you all to see. We have a significant increase of extreme climate events, and this is speeding up in a way that is causing of course, first of all, number of deaths, extraordinary number of deaths, but also economic stability in different places, some places more than others. Developing countries, by the way, this is also empirical evidence, are the ones that are being more impacted by that, and that are the least capable of adapting to this situation. Okay. The cost of inaction is extraordinary. I mean, if we do not act, I'm just looking at the economic numbers, but you can see we're talking about the possibility of wiping up a significant chunk of the GDP, and that is going to be particularly in those countries that are more impacted by extreme weather events, and that is developing countries. So development is all about adapting very quickly and transforming the economic system, because you need to do the transformation in order to get a more just development for the future. There are other economic consequences that are not, and this is important for the rest of the things I'm going to say next, You have, first of all, you have what I call a vicious cycle of inaction. When you do not act now, you're going to have impacts in the future in the forms of stranded assets, reductions of revenues, that is going to make it even more difficult for you to react. And when that happens, then you have a new wave of lack of capacity to adapt and to respond to extreme climate weather. This is more or less obvious, but it's important to remember that there's an economic basis on that, and people have been talking about that. When you start talking about stranded assets, we're saying they're assets that will not create revenues enough to justify their existence, and this is coming from, what we couldn't come, for instance, from infrastructures that cannot be used. It comes from economic systems that cannot be run. I don't know if you've seen, there are several cases of that. What happened in my country, in the state of Rio Grande do Sul, when you had a flooding, where at the same time the economic industry, the local economic industry, was incapable of paying their debts, but also the local government could not continue to function. So you have public and private impacts of this process. So, and of course we have two paths here. We adapt and transition, we transform, and then we have a chance to have something more, what we would say more, a more fertile ground to do the transformation required for a just transition, or we face the consequences. And of course, when I say to transform, it's not just to transform the economic system, but to transform the whole way we produce energy, we produce goods, we transport goods and people around the world. Now, let's go into, remember I said I had some pillars to talk about financing transformation. And that Keynes sort of released me of that when he talked about the investments, the investment function is his monetary production economy, which later on became his principle remind me, effective demand. Okay, basically what he was saying is that you need the animal spirits are the one leading to increasing investments, and the only constraints that they have is access to liquidity. So the question was how to reduce liquidity preference or how to increase liquidity itself. So there was a role of monetary authorities and a role of inducing other wealth holders to hold liquid assets in favor of illiquid assets. So what is the problem with this thing? Thing is that when he was talking about finance and funding at the time, the mobilization of resources is much lower than what you need at the moment. At the moment, just to give an idea, the climate finance has reached $1 trillion a year recently, and I'm going to talk a little bit about this in my 2 minutes and 45 seconds. But we need at least $8 trillion for the next 30 years. So how to mobilize that amount of resources is an incredible challenge that goes beyond just thinking about finance and funding in a more conventional way. I cannot see what that is saying, but it's the issue of liquidity preference is not as simple as we had in these discussions, because you have at least two types of risks related to climate that are not easily addressed and are really substantial. One is transition risk. It's basically the change of regulation, but also society's perception of what it needs to be done. But you have physical risk, which is increasing very rapidly, much more rapidly than people had expected. The second thing is, when it comes to development financing, times of change, the needed transformation, is that normally development is about financing investments that are, I would say, plain vanilla, infrastructure, education, and so on. And you have some additional transformational investments that are very high in risk, and you have a top there that are really transformative, that are difficult to be financed. Normally, the state finances the top transformative assets because of the size of the risks involved. Now, yeah, I lost it completely. Somebody, let me see how I can find it back. No? Okay. So we have had three models of financing this transformation. One is the US model under the Inflation Reduction Act. Basically, it comes from budget. You say the state is going to finance this is the future, and the private sector is aligned behind that vision and the finance in order to get the additional resources to be mobilized. The European Union, when you have private financing come from issuing green bonds, yes, just a little bit part of that, significant part of budget, and the other parts for using transfers of allowance obtained on cap and trade in order to finance. So it's a mixed public and you have, of course, some of East Asia, but particularly China, where you have an alliance of monetary authorities all the way to the markets and state companies and industrial policy in order to promote that transformation. So the fourth thing that is Minsky enough to, as a pillar, can I have still 2 more minutes? Is that okay? Can Minsky's story of financial fragility or his hypothesis enough to understand the issue that we have in front of us? No, not really. As a matter of fact, what happens now is that when you look at his, this is just a formulation, don't look at the formula, doesn't make a difference what I'm, but its basic idea is this: when you have a process of transformation, increase of investments, you also increase the financial fragility because there's a mismatch between your financing and the sources of finance. When you add that climate risk, you have a tendency of decline or even sudden stop of revenues necessary to repay your debts. When that happens, then you have, from financial fragility, you have a jump into financial crisis. This is what is happening in most parts, particularly in developing countries, that when you have extreme financial crisis, extreme climate event leading to a debt crisis. So this is a way to say it. And so can climate make it happen again using the means? Yes, it can. And in much abrupt way, in the sense that if you have, for instance, if you have a flooding in Florida nowadays, the whole insurance system is going to collapse. It's collapsing in different parts, but they're just withdrawing from financing, from insuring. But if there is a flooding, there's going to be a major financial crisis. So my conclusion is this. We're facing a need of transformation that is much more significant in developed countries, but also in developing countries than we had in the past. The issue is the financial needs are much higher. The risks involved are also much more significant. Finance requirements are also much more significant than we had in the past. Patient capital is needed. When you have constraints on that's another issue, when you have constraints from different in developing countries in public finance, and there is a risk of financial stability caused by stranded asset financial and other shocks. So I'll stop here. I hope this is food for thoughts for the young people, and I'm going to be talking more about this on Wednesday when I talk about development finance in times of climate emergency. Thank you. I'm sorry for having extended.
Okay, great. This one works too. Thank you so much, Rogerio. I was thinking about being like, no, we're running a tight ship. You will not have your 2 minutes. Speaking of ships, I opened that great string of panel remarks by talking about how there's so much more than recession and growth, right? And yet, when we leave after this week and we go back and, for the journalists here, we're writing our stories about sort of the TikTok of economic data, and folks are back to either writing papers or being quoted in newspapers about those cycles. We end up trapped in this sort of mindset of just asking bull market or bear market, upside risk to oil prices or, downside risk, trade war or no trade war. And there's so much richness that you all just unearthed about everything in between. And I thought of my friend Owen Davis, who's an economist, speaking of a quote that he gave me for a story once about how we really need to find a way to talk about our economy other than we're on a cruise ship. The cruise ship is sinking, oh no, or the ship is cruising, right? Like, let's talk about the ship. Like, what are the accommodations on the ship? Is the captain drunk? Is he competent? What are the cabins like? Is there, are they pretty spacious and accommodating for people, or are there people living in slums right? We can go on and on and on. And so the question before we open it up that I have for you all is how, for each of you three, should we score our economy? So I wrote some things down just off the top of my head, right? Of course, there's consumer sentiment, which, Pavlina, you pointed out, is sort of under attack, but maybe we should still consider taking seriously. GDP, right? Then there's unemployment within that. There's underemployment, et cetera, et cetera. Real wage growth. There's also growth in household disposable income. Those are just some things off the top of my head. Of course, there's plenty of other indicators. So, Leila, I'll start with you, and especially in the context of your talk, and then we can just go down the line. Stepping back from the news cycle and thinking about things outside of bear market, bull market, growth, recession, what do you think is the best way, or some of the best ways, to score our economy, especially in a equitable way?
I think that's a hard question. Well, so if I were thinking about scoring the economy overall, I would want to think about all kinds of things that you mentioned, which I think are, and then maybe I'll try to think about some of them that are related to what I talked about more specifically. But I think that things like real wage growth would be absolutely key in thinking about affordability and the reasons why people have been so dissatisfied in an economy that otherwise looks, by some conventional measures, very strong. I think links up to that. I think in terms of scoring, without giving an incredibly specific answer, I think that a couple of things that are important are thinking about sort of very long-term trends, right? And that perhaps ties a little bit more closely to what I was saying. So maybe moving back from sort of a specific data cycle and thinking about the really long-term context in some of these indicators that we use to score would be important. And using maybe I might sort of raise this question of a very long-term lens as one thing. Yeah.
Can I use your analogy of the cruise ship?
Yes.
Okay, so we're on the Titanic, and you have a captain that is dealing with known unknowns or unknown knowns. He knows there's an iceberg field out there, and he's bound and determined to ignore it in order to achieve his goals. And I'm not talking about Donald Trump, I'm talking about the economy at large. And you have a very, very nice first-class section, incredibly luxurious, everything you can imagine. And everybody below decks is slamming at the gates trying to get up and out. And that's basically, a nutshell, if you want to use your analogy. What we have is a highly polarized society. We have a group of people who are heading towards a massive age-driven retirement crisis with no assets. That is the thing that, if anything is out there that's going to light the match, that's the one I think that's going to do it. There's so much talk about intergenerational wealth transfer that I think it was Glickman, I think, wrote the paper on that. I don't know about you, but I'm living forever and my kids are getting nothing. But the upshot of all of that is that there's way too much talk about intergenerational wealth transfer, but it's occurring in a microcosm of society. The rest of society is heading towards a very difficult old age. They are going to be a considerably large voting population, but they're going to be joined by this generation, whatever it's called, the A, B, C, D, X, Z, right? Sorry.
Alpha? I think we're on alpha.
Yeah, right. Alpha, right? That is just basically repeating the millennial experience after the financial crisis. Millennials have done a little better, I think, than they were then, but it's going to be very, very difficult. And I think restructuring that and getting to a shared prosperity type of economy is going to take a great deal of work. On the one hand, if you don't mind, on the one hand, it really involves the rejection of the Reagan-Thatcherite notion that government is evil. We need collective action solutions to most of these problems. Okay, thank you. And I'll accept your political contributions. But the problem is that it can't imply, a vast takeover of the economy by the government, because we tried that. I mean, we tried Great Society, we tried other programs that didn't work out so well. But the way to think about it, and this is where I'll stop, but I want you all to think about it. Think about things that can be done within the economy and the management of capitalism, if that's what we're going to perpetuate for a while longer, that minimize, really, rent-seeking. I mean, that's the answer to this question. Rent-seeking in its classical sense, meaning, extraction of rents without increasing production, right? Rent-seeking is the key to all of this. That is why labor share goes down. That's why capital share goes up. That's where we have a problem. And it's occurring in the area of essential services, and provision of essential goods, housing, healthcare, all these other things. And I could talk for an hour on this, and I'm going to stop. But that's really where we need to focus, is the minimization of rent-seeking within this economy.
Gotcha, thanks. And Rogerio, I extend the question to you with an addendum. Obviously, we've been growing, global growth. I think, with, again, those exceptions of the 2008 period and 2020, but we've been growing in a very carbon-intensive, harmful way. Right now, there's a lot of talk about, yields, especially on the long end across the globe for sovereigns going higher. And without stepping on the toes of a talk that's coming up later today, there's this thought that, we had our chance in the 2010s during secular stagnation to have these long-term, means of climate financing, and now we're screwed, and I guess we just have to let ourselves or our children or grandchildren burn. Within the context of this conversation about how we score the economy, but also within the context of your talk about climate financing, what's your bull case for there still being fiscal space for sovereigns, especially outside of Germany and the U.S., to still make these commitments and save the planet and keep it sustainable? And then I'll please open it up to the rest of everybody.
And we have until tomorrow to talk about the issue, right? Okay. But thank you. Let me tell you that I may have sound pessimistic. I'm not. Let me explain to you why. Never in my whole life have we had so much resources and technology to mobilize in order to do the transformation. This is the extraordinary thing about it. And when we think about development, look at, for instance, when I was 30, when I was looking at, when I was 20, I was looking at China or Korea. I remember reading a paper about Korea that South Korea will never develop because of its religion's inclination. I mean, I'm not going to quote the economist, so much wrong thinking, so pessimistic. The fact is, even economies with little resources, transformation was feasible. Never have I seen in my life so much technology and resources available to pursue the transformation. Everything else is human construction. That it starts with the macro financial issues, fiscal space. I mean, first, I come from a country that should not have any policy constraints. The constraints are created by its own macroeconomic arrangement that has been developed for 10 years. It can be undone. And then you have an incredible fiscal space, even in countries that are facing much more significant balance. For me, it's all about balance of payments when it comes to development. But that's another discussion we're going to have on Wednesday. In this country, there's no restrictions for transformation. And organizing both the government expenditures and space and climate finance is a question of institutional will. The question that I would leave, and I say when I say I'm not pessimistic, is for the young generations to say, first of all, how to get the drunk bully of the captain out as quick as possible, and then face a question that my generation in Brazil, for instance, had. What do we do from now? You have to be prepared to answer that question at the moment that you get the drunk bully captain out. And I think this is the role that we as academics, we as thinkers, we as civil society have, not to think about the Titanic, but think at what if we had the possibility of using the resources that we have and mobilize them for transformation. I don't know if I answered your question, but I...
No, that was great. Are you running a campaign? Those in the back that are meant to help me out here. So are we going to have people come down the aisle, or y'all handing out mics? Okay, great. So does anybody have questions? I'm missing somebody. Right? Don't be shy. Oh, the gentleman in the center right here.
Yeah, many years ago I used to feel lawyers were the last people that should be politicians, just because of all the details they like to bring to slow things up. But the last few years I've come to the conclusion that it's more local politicians and businessmen that shouldn't be politicians at the federal level. And my thoughts there are that, I'm a systems engineer, and I think about in terms of optimization functions and complex multimodal problems that need to be solved. And my impression is that the optimization function for capitalism is profit, which I understand and I support, but that too many, it comes over to the federal government anyways, being applied as the optimization function for the federal government, like efficiency and minimizing costs and things like that, where the real optimization for the federal government should be meeting the basic needs of all of everyone, not the basic needs of the private businesses and capitalism. Could you comment on that?
Leila, how about you take that one? And if we have time, Dan as well.
Yeah, I mean, I agree with the last thing that you said, that to the extent that this profit maximizing calculus moves into the federal government, that's a mistake. I don't think I have anything to add. I think it's a great point.
Briefly? Yeah. Sounds like we're all in agreement. The woman in the center.
Thank you, good morning. I would like to ask about the role of the state in this challenge about the climate change, because what I have seen working in energy transition is that some private projects are successful when they have the support of the state, when they have funding, when they have tax incentives. So in the energy sector, the role of the state, I have seen it's very important to achieve the necessary financial, the investment needed to get the change to clean energy. That's in energy sector, but I think maybe it could be in every sector, something similar. So I would like to hear your opinion about this role of the state funding and financing or putting rules to finance the energy transition and the climate change in general. Thank you.
Thank you. Yeah, I'll do rapid fire right after you. But Rogerio, want to maybe answer that by expanding with even a bit more specificity what you mean by the ability to move beyond our perceived constraints. Like, for example, she brought up taxation versus, maybe issuing bonds. What are just quickly some of the things, some of the options?
I think that the role of the state is what the role in this transformation is what the role of the state has been throughout the history of development. And when I say development, say both for what we know now as developed countries, from Germany to Japan and so on, in trying to create a horizon, but also this country. When Kennedy said, let's put a man in the moon. He should have started with a woman. We'd be much better off, by the way. But you create a horizon in terms of where the private sector is going. You provide incentives, and you bring the private sector with you. The more complex and challenging the goal, the more you need that. Let's talk about a little bit of complexity. We talk about risks of investments in transformation. Most of the time is complexity. You have, for instance, if you want to create a new green hydrogen, you have to both connect the policies, but also the sectors need to develop each part of the chain production. Dealing with complexity is something that the private sector normally does not do, because they want to do something which plain vanilla. It's nothing, I'm not blaming the private sector. This is the objective function of the private sector. They can do well if the states provide, deals with the complexity and provides with the horizon. I hope that makes sense to you.
Yeah, very cool.
The one thing to remember about energy policy is that, and I'm glad you brought up putting a man on the moon. Other than very few fiscal conservative voices back then, there was no anti-man on the moon lobby. All right, today we are still beset by an enormous fossil fuel lobby. And they are the bad guys, right, in this debate. I mean, if you favor a transition. And to the extent that you are dealing with the political reality of that, which comes in the form of effectively buying legislators, the state is hampered in providing the support that it obviously should be. So, that's the real answer, at least in the United States.
So, there's good news and bad news. Good news, there's lots of hands up. Bad news, we are pushing against time. Good news, these three people aren't going anywhere, and you can still find them. And how about we give them a round of applause? Thank you all.